How's it going, y'all? I'm Matt Poza, and this is Matt's Money Mindset. In today's video, we're going to be talking about investing basics and why it's important to just start. Even if you only have a dollar or two, just start. So let's jump into it. A lot of people tend to think that investing is like gambling or throwing your money away, maybe with the prevalence of a lot of these new meme crypto coins coming out where people see, oh, you jump in, you make tons of money, but then maybe they go to zero. I would say probably 99% of those are going to zero. That is definitely what you would say is gambling. That might be throwing your money away. You might be better off just taking a trip with your friends over to Vegas, putting it all on red or black. But this is not what we're talking about today. We are talking about smart investing for the long term, having goals in mind. So you want to put your money in something that is easy to track and safe. What you're actually going to want to know is that if your money is in a savings account, you are losing money every year. The average inflation rate since 2000 has been about 2.5% per year. So if you have your money in a savings account, you are not getting any interest on your money. So you are losing 2.5% of your buying power every single year. So at a very minimum, you're going to want to put that money in a money market fund because you're going to get at least whatever the inflationary rate is set by the government. But even better than that, you're going to want to put it into something like an S&P 500 fund, which I'm going to be going over today. So there are a couple of very easy options for S&P 500 index funds. You could go the ETF route or the mutual fund route. An ETF is just more of a passive managed fund, so the expenses on that are going to be a little bit lower. And a mutual fund is a little bit more of an active managed fund, so the expenses will be a little bit higher. But both are still very, very minimal. Just to expand on that a little more, exchange-traded funds and mutual funds both represent professionally managed collections of individual stocks or bonds. They're both less risky than individual stocks or bonds because they spread your investments across a broad range of asset classes, sectors, and geographies to bring you built-in diversification, a strategy that's intended to help lower your chances of losing money on investments. One fund could include tens, hundreds, or even thousands of individual stocks or bonds to help reduce the impact of a single security's poor performance. For example, if one stock or bond in the fund is doing poorly, there's a chance that another is doing great. The strategy can help stabilize your portfolio by potentially offsetting losses in one area with gains in another. Today, I'll be focusing on S&P 500 index funds because these funds track the S&P 500, which tracks the performance of the 500 largest US companies, making this collection of stocks inherently less risky. And you'll be getting very good returns on that. I like to say as a rule of thumb that you should be getting about 8 to 10% returns on your money year over year. So if you had your money invested for say 20 years and you were getting 10% per year, you could just imagine how much that would grow to, and I'll be going through an example of that later in the video as well. All right, so to move on to how you find some of these funds, you can go to pretty much any website that has investments. I'm going to be going through Vanguard today, but you can find these funds on pretty much any exchange that you want. So whether you have Vanguard, Fidelity, even Robinhood, just an easy app on your phone to use, you can find an S&P 500 index fund anywhere, and you can get started for as little as $1. So to get there, we're just going to Google Vanguard. So once you've Googled Vanguard, easy, just click on the top one. We're going to want to go to their personal investors portal. And then you're going to want to open an account. Should only take a few minutes. You'll put in some of your personal information, connect a bank account, send some money over. But then once you have your account, you're going to want to search. And the S&P 500 index funds, you can just search S&P 500. Or if you want to make it easy, they have VOO is their ETF. So VOO. Or if you want to do the mutual fund version, it is VFIAX. VOO, the Vanguard S&P 500 ETF fund. So you can tell what it is. It's an index fund. It tracks the S&P 500 index. Easy enough. The S&P 500 is a blend of the 500 biggest companies on the US exchanges. So think your Apple, your Google, your Microsoft. The biggest companies in the US are on this S&P 500 index fund. It's just a big bucket of all of those companies. So it tells you your risk reward scale. It tells you you're at a 4. It's technically more risky because it's stocks rather than bonds, but if you look at the historical returns, the risk is very low. Your expense ratio for this, 0.03%. So they're taking essentially nothing off the top, and that also only comes out of your dividends and your capital gains. So very, very little money taken off the top. And then we're going to want to just ignore this price completely. It's $559 as of recording this, but that doesn't matter. You can start with as little as $1. It'll just give you whatever the proportion of that fund is on that day. So when we come down and we see minimum investment, $1, that's what we want. You can get started today. I guarantee you everyone has $1 that you could put into this fund. All right. And then if we go over to VFIAX, it's basically the same thing, a slightly higher expense ratio because, like I said, it's a little bit more of an actively managed account. But other than that, it's pretty much the same except for this $3,000 minimum investment. So the ETF, definitely easier to get into, only $1 versus $3,000 for that minimum investment. And they're basically the same basket of goods. They're both S&P 500 index funds. If you scroll down on the page, you can see what it is invested in. You can see it broken out by percentage, what sector is where, how much it's made up of. So we've got information technology at 32.5%. That's because the Apples, the Googles, the Microsofts are in that bucket. And then if you keep scrolling down, it'll actually tell you the individual companies. So we have Apple, Nvidia, Microsoft, Amazon, Facebook, Tesla, Google. Those are your top companies. It tells you exactly how much percentage of the fund those are. Now we're going to look at the historical returns. So this is for VOO. The 10-year returns, that's what I like to look at, 13.06% returns. So in our example before, if you had your money in a bank account, you're getting $0. And like I said, you're losing about 2.5% per year to inflation. If you had your money in here, over the past 10 years, you would average 13.06% on your money. So if you take away the 2.5% for inflation, you're getting more than 10% growth on your money every year. And then same thing if we go over to VFIAX, the mutual fund version, the exact same 13.06% on your money. Like I said, they're the same funds. It's just an ETF versus a mutual fund. Now, just for a fun activity, I like to use this NerdWallet compound interest calculator. So let's say that today you decide that putting your money in a S&P 500 index fund sounds like a good idea for you. Let's say you have $5,000 left over that you can afford to put in this. And then let's say you're going to put $100 a month in. Let's go with a conservative 8% estimated rate of return. If you started today with your $5,000 and we're putting $100 a month in, at the end of that 5 years, you would have gained $4,000 in interest almost. So your $11,000 investment, the $5,000 plus your $100 a month, would have grown to almost $15,000. So if it was sitting in the bank, you would still only have that $11,000, but now you have almost $4,000 extra that you can spend on top of your initial investment. What if we let it grow for 20 years like that? At the end of the 20 years, you would have made $54,000 on a $29,000 investment. So 20 years from now, your $5,000 initial investment and $100 a month grows to $83,500. Let's start playing in the big leagues. Let's say that you can afford $1,000 a month, even just for 10 years of growth. Now you have $194,000. You made almost $70,000 of interest. Let's say 30 years of growth. If you're 35 right now, you want to start investing, you do $5,000 now, $1,000 a month. let it grow for 30 years until you want to retire at 65. Total principal, only $365,000. That's your $5,000 and $12,000 a year for 30 years. But your interest is almost $1.2 million. So over the course of 30 years, your $365,000 has more than 4x'd itself. And that's all you have to do. All you have to do is put your money in the market. It is not gambling. This is how you build wealth, how it's forced savings. You just save a set amount of money every month and send it right over there. Don't worry about pulling it out. It grows for you, much better than a savings account. I hope you enjoyed this video on just some quick investment basics. Just putting your money in the S&P 500 index fund is going to be the best way to build wealth, build growth. It's very hard to beat the market, so there's no need to be investing in individual stocks or these crypto meme coins. Just anything you have left over, dump it right on into an S&P 500 index fund and forget it. If you want to get more technical, you can definitely learn more about other types of funds. There's large cap, there's growth, there's mid cap, small cap. There's a lot of different types of funds, or you can do the individual stocks if you want to, but this is the easiest way to get in. Like I said, minimum $1. That's all you need to put in, $1. Everybody can start today with $1. If you enjoyed this video, give me a like, a comment, subscribe to the channel, and I look forward to interacting with y'all and seeing y'all next time.